Most people never open their RRSP statement, not because they don't care, because they're afraid of what they'll find. And I understand that. I've spent decades studying how people make financial decisions. And fear of the number is one of the most consistent patterns I've ever seen. But here's what I want to tell you today. The number itself is rarely the problem. The problem is usually what surrounds the number, what nobody explains. So let's start with what's real. According to Statistics Canada, the median Canadian at age 65 has approximately $100,000 saved in registered retirement accounts. Not the average, the median, the middle person. Half of Canadians entering retirement have less than that. Now, I want you to sit with that for a moment, because $100,000 is not nothing, but it's also not what most people imagined when they started working 40 years ago, so the question worth asking is, how did we get here? Part of it is simply life: mortgages, children, divorce, medical expenses, decades of competing financial priorities. But part of it is something more structural, something that doesn't get discussed in the headlines. Here's the first thing most people don't understand about their RRSP. Every dollar inside it is pre-tax money. That sounds obvious. But the implications aren't always obvious. When you contributed to your RRSP, you received a tax deduction. That felt like a gift, and in many cases it was. But the government deferred the tax. They didn't forgive it. Every dollar you withdraw in retirement is taxed as income, at your marginal rate. And here's where it gets more complicated. If you build a large RRSP, say $400,000 or $600,000, you may find yourself in a higher tax bracket during retirement than you expected. And above certain income thresholds, your old age security payments begin to be clawed back. The system essentially penalizes successful savers at a certain level. That's not a conspiracy. It's just a structural reality that most people discover too late. Now, here's the one that catches people completely off guard. If you are single and you die with a large RRSP and no qualifying spousal beneficiary, the entire balance is deemed income in your final tax return. Every dollar, in a single year, at the highest marginal rates. In some provinces, that means the government collects close to 50 cents on every dollar above a certain threshold. A lifetime of disciplined saving, partially transferred to the state. I'm not saying this to alarm you. I'm saying it because it's one of the most consistently misunderstood elements of Canadian retirement planning. And the solution, or at least part of the solution, has existed since 2009. The tax-free savings account. Now, I know this sounds like a basic comparison. RRSP versus TFSA. You've probably heard it before. But most explanations miss the deeper structural point. The RRSP was designed in an era when Canadians retired into lower tax brackets than they worked in. That assumption made sense in 1957. It makes less sense today. For a growing number of Canadians, particularly those with pensions, rental income, or investment income in retirement, the tax bracket in retirement isn't meaningfully lower. In those cases, the TFSA wins on nearly every dimension. Tax-free growth, tax-free withdrawals, no impact on income-tested benefits, no deemed income on death. And yet, as of the most recent data I've reviewed, the average Canadian has significantly more in their RRSP than in their TFSA. Old habits are powerful. And the financial industry has had decades to build the RRSP contribution ritual into our culture. Now, I want to talk about something that almost never enters this conversation. Renters. The standard Canadian retirement model assumes a paid-off home, CPPOAS, a modest RRSP, a house with no mortgage. That model produces a livable retirement for a large portion of the population. But a growing number of Canadians are entering their 50s as permanent renters. Not by choice in many cases, simply because the cost of housing in major Canadian cities moved beyond reach during their peak earning years. For these Canadians, the retirement math is fundamentally different. $2,000 a month in rent, growing at 3 to 4% annually on a fixed income of $24,000 to $30,000 per year. The numbers don't close. This is not a minor detail. This is a structural gap in how we talk about retirement in this country. And it's a gap that affects millions of Canadians who are doing everything right, saving consistently, managing debt carefully, and still facing a retirement that doesn't add up. Now let's talk about the number that generated the most anxiety in recent surveys, $1.7 million. That is the amount Canadians said they believe they need to retire comfortably according to BMO's 2026 Annual Retirement Survey, up from $1.54 million the year before. And I want to offer a different perspective on that number. Because I don't think it's simply a reflection of what Canadians need. I think it's partly a reflection of what Canadians have been told they need. There is a very large financial services industry in this country, and a deeply anxious retiree is a very good client. That isn't cynical, it's structural. The wealth management industry, the insurance industry, the mutual fund industry, they all benefit when Canadians believe the retirement gap is enormous and they need professional help to close it. I'm not saying the $1.7 million target is wrong. For certain lifestyles, in certain cities, it may be realistic. But for a Canadian who owns a modest home, maintains reasonable spending habits, and draws full CPP and OAS, the math looks very different. Statistics Canada's own data suggests most Canadian retirees live on approximately $37,000 per year. Not luxuriously, but not in poverty either. The gap between what people have and what they think they need is largely a psychological gap. And that gap has been, in some cases, deliberately widened. Here's the last thing I want to leave you with. The most powerful financial decision most Canadians can still make isn't choosing between the RRSP and the TFSA. It isn't timing the market. It isn't finding the right fund. It's understanding the system they're operating inside. The rules around contribution limits, withdrawal sequencing, benefit clawbacks, and estate taxation are not complicated once they're explained clearly. But they are rarely explained clearly, not because the information is hidden, because informed Canadians make fewer expensive decisions. The data on Canadian retirement savings is sobering in places, but it is not hopeless. The median 65-year-old entering retirement today, with CPP OAS, a paid-off home, and $100,000 in registered savings, has a functional retirement. Not the retirement the industry advertises, not the cruise ship version, but a real one. The question is whether they understand the system well enough to protect what they've built. That's what I think about when I look at these numbers. Not how much people have saved, but how much of it they actually get to keep.